Great. Welcome back to this transition event with the JSE and IFC. And we're very pleased to welcome you to the next panel discussion. Now that I'm taking over as MC, just a brief introduction from myself. My name is Louise Gardner. I am the Africa coordinator for the Sustainable Banking and Finance Network. It's a learning platform facilitated by the IFC for financial sector regulators and banking associations from emerging markets. We represent 43 emerging markets currently, and one of the very active countries in that network is South Africa, represented by Banking Association South Africa, National Treasury, and the Prudential Authority. And we've had the pleasure of collaborating with the JSE on various initiatives to catalyze green finance in South Africa. So this is another of those events, and I'm very pleased to be with you today and to be introducing our next panel, which will focus on transition finance, just another label or a new paradigm for the financial sector. So credibility and preventing greenwashing is a big part of ensuring that the transition finance sector will be successful. So with that, I'm very pleased to introduce the panelist for that session, or the moderator for that session, Sean Kidney, who is CEO of the Climate Bonds Initiative. We've had the pleasure of collaborating with Sean many times in the last few years to raise awareness and help guide the sector as it evolves. And Climate Bonds Initiative were also one of the first to help provide guidance on what transition finance should look like in their partnership with Credit Suisse last year to publish guidance on financing credible transition. So you're in very safe hands with Sean, and I will leave it to him to introduce his panelists. Sean, over to you.
Thank you so much, Louise. Thank you for all the work you've been doing to grow sustainable finance in Africa and in South Africa. If you don't know, that Louise is one of the heroes of this movement over the last so many years. But look, we've come a long way. I'm in Brussels at the moment, and I've just been to meet the European Commission DG Budget, who yesterday issued green bonds of 12 billion euros, and they had 130 billion euros of orders. We're in a green finance market that is going utterly crazy around the world. They are cock-a-hoop. That's twice the oversubscription rates that they've received for other bonds they've been issuing this year for, I'm going to call it the non-green aspects of their next generation EU program. This is a story that's being repeated around the world. In South Africa, what we're looking at now in this discourse around finance related to achieving our climate goals is what is happening around transition. I mean, South Africa is in an unusual position. It has a huge transition to go. It is much more carbon intensive than any of the other comparable economies. It has possibly the world's most carbon intensive company, which would be Sasol. And it has a huge just transition social challenge in making a shift towards low carbon, sustainable, financially rewarding going forward, while managing all these other dimensions for it. And hence this particular panel. The session is called Transition Finance, just another label or a new paradigm for the financial sector. You probably guessed what I think, but hey, let's see what you think by the end of it. I have with me today, first I have Nazmira Muller, who's the Deputy Managing Director of South Africa for 91. Some of you might remember that as the old Investec Asset Management, who's going to join us in it. I have Saul Levin, who's the Executive Director of Trade and Industrial Policy and Strategies for TIPS. And then, of course, I have Nicholas Pfaff, my old friend from the International Capital Markets Association, who's the Managing Director and the Head of Sustainable Finance. For those of you that may not know, the International Capital Markets Federation is the manager of the Green Bond Principles, which has been an important global initiative over the past, is it 10 years yet, Nicholas? Guiding the reporting and transparency provisions, which have really ensured credibility for the green finance market. And of course, we're looking to make that work for the extension of that into the transition finance. So thanks everyone for joining us. I'm just going to make a couple of remarks if I can, and I think I might even be able to share a PowerPoint. But look, I want to say we've seen a really rapid growth of green finance, especially green bonds globally. That's the key point about why we're seeing this appetite, this change coming forward. From the green bond space, when I started working in this some 12 years ago, we had less than $1 billion of issuance. We now have a market, I hope you can see that on screen, where we have $1.5 trillion outstanding just in the green slice. And then we've had expansions of the idea, let's call it the daughters of green bonds, social bonds, sustainable bonds, and others, from all sorts of issuers around the world. And we now have a green and sustainable and social bond market, which is around $2.5 trillion outstanding, about 100% growth expected in 2021 on last year. It's extraordinary growth. This particular market has led to some other changes, some other developments. This idea of a use of proceeds market, where a company like Eskom, for example, would be allowed to issue green bonds for renewable work that it's doing, even though it might have a very strong coal portfolio, has been an important idea. In ESG world of thinking, environmental social governance, which grew out of equities, these were scoring systems for whole entities, for corporations. For many organizations, they didn't score very well when you looked at their overall balance sheet. But at the same time, the investments in solar or other kinds of green investments were still really important. So the use of proceeds market, the green bonds market, grew up really as a kind of response in the fixed income space to that. Yes, we want Eskom to invest in renewable. No, we do not want Eskom to continue on a high carbon path, long term or even medium term. We need a change. This reconciles the two. So this market, which is essentially, it's a bit like, if you go to your uncle or your aunt and you say, I want to borrow money to buy a car. And your aunt says, well, that's lovely, dear, but I'd like you to buy an electric car because that's the way of the future. And you say, sure, I'll buy an electric car or maybe even a hydrogen car. And I'll come back every Christmas and take you for a drive to show you how it works and how good it is. That is essentially what a green bond is. You're borrowing for someone and you're promising every Christmas, or at least on an annual basis, to report on the transaction and how it's gone. So it's an incredibly simple model. And that's why it's grown so well. Of course, as a result of the growth of that market, we now see the growth of taxonomies around the world. And we have one in South Africa, which has been put out by Consultation for National Treasury. We have, which Louise was instrumental in developing with the support of the IFC. This is the idea that we provide clear guidance about whether the solar plant does qualify or not. But let's go way beyond solar. Let's look at Sasol's recent announcements around green hydrogen plants, which are very exciting. Is that in? Does that qualify as part of investment that will address the nature of the climate and environmental challenges we face? So the Climate Bonds Initiative did a taxonomy 10 years ago that's been influential in guiding the green bonds market. And then about 6 years ago, we managed to convince the Chinese People's Bank of China, the Chinese government, to introduce a taxonomy to guide the development of the Chinese green bond market, which it has very successfully, now the world's second largest green bond market. And the European, a year later, we had a similar success with the European Commission. And just last week, finally passed the regulation, the legislation, to confirm the European taxonomies. Now, this is useful because, boundaries need markets. I should say markets need boundaries. If you establish a market with clear boundaries, it grows much faster. We know this from all sorts of history of financial markets. We need to be able to draw a line in areas that are complex for most people because there is confusion. There is confusion. For example, is a forest good or not? Well, yes. Is a forest of eucalypts good or not? Well, possibly, and so on. What kind of agriculture is relevant and what kind is not? How do we tell these things? Guidance for the market, which can then become global in application, is critically important. The global aspect is happening. In November this year, we will publish, and we've been working with the European Commission on this, a common ground taxonomy between China and Europe, which exactly as it says, identifies the common ground between the taxonomies of those two countries as a global good, a contribution to the discussion in many other countries. Of course, South Africa has already published a draft taxonomy, which is very in line with the European taxonomy and designed to ensure that we can encourage capital flows from Europe in green. In Europe, this has also led to a disclosure regulation around sustainable finance. All investors, banks, and corporations will need to report on an annual basis to their regulators about the sustainable investments, CapEx and OpEx. There's a whole complicated guidance around how to apply different kinds of cash flows and capital flows linked to the taxonomy, which is now a piece of regulation in Europe. In other words, a common language is finally in place. This hasn't been the case in the past. Everyone has been making up their own story of what is green or what is sustainable. Now we have full comparability, and in fact, we'll be able to see how sustainable different funds are, whether AXA is as sustainable as Allianz in terms of its balance sheet, which will probably lead to a race to the top. But let's see how that goes. There are many different flavors of taxonomy application when it comes to instruments. Now, there's been a lot of confusion about this. We've seen sustainable bonds, enabling bonds, blue bonds. We've seen transition bonds, social bonds. The way we would present the situation is that they're all different flavors of ice cream in terms of making the Paris Agreement consistent. And that needs to apply to transition as well. We can't have transition to nowhere. We've got to have transition to somewhere, and that is very clearly the Paris Climate Change Agreement, our global goals in this area. You'll see more. You will see different flavors of bonds and other financial instruments starting to appear in this market, all within the same broad and liquid. We're trying to avoid illiquidity premiums here for those of you who are fixed income investors market, but will also allow different issuers to burnish their particular credentials, in particular subject to meeting a global guidance and taxonomy going forward. Of course, the question is what happens in the transition area. So finally, next, what's going to happen in this market? You will see a lot more coming through about making it easy to know what to do. We're working in Europe, at least, on social, on circular economy and various other definitions that are coming through. And South Africa will be able to consider whether it wants to use those for its taxonomy going forward. We will see then a lot of preferencing. I'm going to call it incentives of various sorts for green investments. We already have the European Central Bank talking about promoting green quantitative easing in line with the European taxonomy. That gives you the universe of what qualifies, if you like. But of course, we already have programs such as the IFC, which will offer you some support for green bond programs, and many other development banks are doing the same. The Asian Development Bank in ASEAN will do the same sort of thing and has been providing grants and credit support, guarantees for green bonds. More of this will come through. And that's important to note because in South Africa, the cost of capital is, of course, critical for these high CapEx, relatively low OpEx kind of solutions. So being able to get down that cost of capital through the support for things like guarantees or first loss provisions is really important to be able to make this transition viable. But there's more to that. Let's go to our speakers. I need to first say I made a mistake. I'm sorry. Simon Utemak, Director of Finance, has in fact placed Nicholas. I knew that, but I was talking to Nicholas last night and my head is spinning around. But Simon is also fantastic. Thank you, Simon, for being able to join us. Apologies for that confusion. Let me now go to Simon, actually, and ask her to start off with her remarks about transition and the opportunities around transition and talk about the work that ICMA has done in this area. And I'll make a few comments later, if I might, Simon, about some of the opportunities in South Africa. Please, go ahead.
Thank you, Sean. And good morning, good day to everyone. Can you see my slides? Okay, thank you. So I'm just going to do a brief presentation, give you the overview. The title of my presentation is Harmonizing Market Developments, Principles and Handbooks on Transition Finance. And at ICMA, we're actually fortunate enough to manage the secretariat for all those principles that have been developed since 2014. And you can see that on this slide. So these are all principles, while the last one that you see at the bottom right is actually are not principles. So this is guidance, but I'm going to talk a bit more about this in a second. So since the principles have been developed, they have really come to underpin the global sustainable bonds market. So we did a study in 2020 last year, and we found that about 97% of global sustainable bonds issued have in fact been aligned with the principles. I'm not going to talk much about this. Sean has just shown you some graphs, but this is also the development. Again, just to reiterate, we have seen enormous growth in the sustainable bonds market, and you can see gradually we've had other daughters or cousins been added to the green bonds. This is an overview of what's happened since 2014 in the African sustainable bonds market. So you see, we've also seen a wide variety of all kinds of bonds: green bonds, social bonds, sustainability bonds, which are a mix between green and social, and also sustainability-linked bonds, which are not use of proceeds bonds like the other three types, but we have general corporate purpose bonds with those. And this is what the African Development Bank alone issued, so quite a long list as well. Now, this is a nice overview which kind of captures the title of the presentation as well, bringing together the principles and the guidance. So at ICMA, we're often asked, why have you not come out with transition principles? For us, it's more, and also to answer perhaps the question of the panel, it's not a label in such that we need principles. You can, of course, label your bond a transition bond if you want to, but for us, it's more a theme that can be used with financial instrument guidance. So you see very nicely in this chart that you have the use of proceeds principles, green, social, sustainability linked with the core components and the key recommendations. You have on the right-hand side the sustainability linked bond principles. And at the bottom, you see the guidance for climate transition finance can in fact be used in conjunction with either of them or both. So just briefly on sustainability-linked bonds, because they have really emerged as an instrument to finance the transition. So we've really seen a lot of growth since these have come out. NL was in fact the first one to issue a so-called SDG-linked bond in 2019. That was after the enormous growth in the sustainability-linked loan market. And then in June last year, ICMA came out with the principles for sustainability-linked bonds. So what are sustainability-linked bonds? They are really forward-looking performance-based instruments. And the sustainability outcomes here are measured through KPIs, key performance indicators, and they are assessed against so-called sustainability performance targets, or SPTs. Let me just go to the next slide. So we're short on time. So the SLBPs have really 5 core components. You can see them on here. Selection of KPIs, as I just mentioned, calibration of SPTs, bond characteristics, reporting, and verification. So KPIs, that's very important. I guess we're going to talk more about this during the panel. A lot of KPIs that we have seen are, of course, based on greenhouse gas emissions, of course, in the wake of COP26 and towards the achieving the ambition of the Paris Agreement. This is very important. But we have also seen the odd ones with other KPIs, such as social KPIs and biodiversity, such as the reintroduction of wild species into the ecosystem. What's very important is that issuers should actually look to their peers to define the benchmarks, or somehow at least benchmark themselves, because if an issuer doesn't benchmark themselves with either peers or, let's say, science-based targets, then it's really impossible to know if the targets are ambitious or not. And that's really, really difficult then for investors. The bond characteristics. So this is actually a key element of the bond. It's really the cornerstone of an SLB, if you will. So there are either financial or structural characteristics which are triggered by events. So if an issuer doesn't reach the KPIs that they have set, so let's say an issuer says we're going to reduce our greenhouse gas emissions by 55% by 2030, and they don't achieve this, then this will trigger an event. And typically what we see in the market today is that this will lead to a coupon step up, actually. There are other suggestions around, but all of them haven't really been viable. So coupon step ups for now are really what we see in the market predominantly. The reporting is really important as well, because as you can imagine, especially with SLBs, you have to report on how are you getting on with trying to achieve those targets. So the SLBP require that reporting is being made at least annually, and for any date or period relevant to assessing the performance of the KPIs against the SPTs. And then verification. This is actually the fifth component of SLBs. This is very important. It is recommended, like with the other principles, that you do that pre-issuance, so that you get, for example, a second-party opinion. But it is actually mandatory to get this post-issuance, because it really has to be verified that you have achieved or that you're on track to achieving the KPIs. We're constantly working on this guidance, so these are the principles, but we have actually developed related Q&As after they came out. We've also come out with a spreadsheet of KPIs. We don't want to be too prescriptive, and we don't want to stifle the market, but this should give new issuers an idea, at least, as to what kind of KPIs that could come up with. I should also say the ECB has come out last year and said they would accept SLBs as collateral, but only with environmental KPIs. So this has really led to even more SLBs being issued, especially on the environmental side. Then let me just continue. So these were SLBs, very important, because as I said, they have actually emerged as an important instrument in this market. But importantly, last year we have also come out with guidance, and this is really not new principles, but this can be used in conjunction with those SLBs, for example, but also with a green bond or a social bond, sustainability bond. What is climate transition finance? What is the handbook? It's really an issuer-level handbook that, as I said, needs to be used with instruments. And interestingly, the book also mentions just transition, which is becoming increasingly important, which is really the opposite coin, if you will, of the transition, so that the transition also works in a fair and just way on the social side. What you can see in the slide in front of you, this is really the handbook at a glance. So there should be, the issuer's climate transition strategy and governance. That's really important. An issuer needs to clearly communicate how it's going to adapt its business model to make a positive contribution to the transition to a low carbon economy. And the establishing of the corporate strategy is really to address climate change risks which is very important for issuing such an instrument. There are certain tools that can help with that, certain transition tools by the NGFS, TCFD, and so on. I guess we might talk more about that in the panel. Then secondly, it's very important that the climate trajectory should be materially relevant to an issuer's business model. So that means, if they have to, for example, if their prospects might change because they might be impaired by government interventions to limit carbon emissions, or if an issuer is exposed to changes in technology, or anything like that. So they really have to communicate to investors, why is this relevant to the issuer? Why do they need this financing from the market, from investors, to really change and adapt to those things? And then the third thing is that the climate transition strategy should really reference science-based targets. I mentioned that already before with the KPIs. That is very important to base this on something that can be benchmarked and that's also measurable in the market. So again, there are various initiatives out there that are providing useful frameworks and standards for that, such as, again, TCFD, SASB, CDP, GRI, and so on. And this also needs to be verified. And then lastly, there should be transparency on the implementation. So the issuer should really provide transparency on where the money is flowing within the business and how this will deliver, how this will help deliver the strategy on decarbonization. So for example, you know, if there are investments in new technology or in industrial partnership programs, and any solutions that will help decarbonize, this is very important for investors to see. I think I'll finish here because I'm short on time, but just also know that the first one and the third one that you can see here, they actually, it's very important, they require verification as well. And as I said, we see a lot of SOBs in the market at the moment, but what the Climate Transition Finance Handbook really adds is another layer of what issuers should disclose. And this is something that investors have really come to appreciate. Thank you for your attention, and I think I'll pass on to the next speaker.
Thanks, Simone. Thank you. And the handbook that ICMA has done on transition is very important, a very important piece of work, market. We've also done some work at Climate Bonds, for those of you interested on financing credible transitions. And just to echo some of the things that Simone has said, we've been saying very clearly we need a 1.5 degree trajectory, because that's now what the IPCC is telling us critical. And also, by the way, just yesterday, the International Energy Agency issued its World Energy Outlook, and it's saying the same thing. If we're to achieve our climate goals, we have to be looking at very ambitious targets, which really means 1.5 now is the norm, not 2, to achieve, to be able to stabilize climate. And there are implications for that for energy use. Science-based is obviously critical in all of this. We've spent the last 30 years listening to, you know, oh, the science is terrible, we can't do it. What about we just do a bit of this? That's really what climate change plans have been for 30 years. We can't afford that any longer. We have to listen to the scientists. The pandemic has really taught us that. And then, of course, actions, not pledges. We can no longer afford a promise to do something in the future. Time is too short. We need actions going forward. Well, at least that's what we've said. Let's hear what an investor says. Nazmira, you're managing a rather substantive exposure to the South African market. Tell us your thinking, your take on transition finance, and is it important? Is it here to stay? What does it mean for you as an investor?
Hi, Sean. I mean, I think that you and I have had a few of these discussions recently, and what is very clear is transition finance, I think, is critical to ensuring that South Africa is able to reduce its carbon emissions. We all know South Africa is incredibly carbon intensive. You talked about Sasol earlier on, but you can talk about Eskom as well. So I'm going to show you a few charts along the way, and in the process talk about how we as 91 are approaching it. My pack's probably a little bit more macro than slides, but I mean, then investing. But I think it's important we remember South Africa has the most carbon intensive electricity grid in the world at this point in time. And the power sector contributes 45% of total South Africa's emissions. Sasol and the fuel sector in general, so the transportation sector, accounts for another 25%. So as we think forward, the transition of both Eskom and Sasol are critical for South Africa. And when we think about how that's going to be financed in each case, transition finance is going to be vital. If you can't raise the money to fund the capital expenditure that's required to reduce carbon emissions in both of these entities, then there is no solution there. So to provide the perspective of the total book of assets that we manage, about 25% is in South Africa, raised from South African pension funds. 91 is the largest third-party asset manager in South Africa, and we have quite a reasonable proportion of that invested in the fixed income markets, whether that is in government bonds, but also in Eskom bonds to some extent in some specific portfolios. But we also have a lot of experience financing infrastructure across the continent. So as we think about this, the context that South Africa is facing and the potential threats that the country is facing from the changing global environment we can't ignore them. So Europe is South Africa's largest trading partner at this point in time. We've seen the carbon border tax being implemented, and therefore the ability of South Africa to export into Europe without tariffs being imposed in the future is now in question. Very little of South Africa's exports is affected by the first round, but as we go forward, there's likely to be a lot more that is included. So as we think about some of the companies we own in the market on the JSE, a lot of the mining companies, platinum companies, their biggest export market is Europe. I mean, it's on-sold often from there, but they could potentially, on a 10-year space, be facing the tariff impact. So dealing with the electricity grid and dealing with the transportation sector as a whole are important to ensuring that a large number of our companies don't face additional hurdles. And therefore, as we think through something like Eskom, there are effectively 4 things that need to be financed in Eskom's transition. The first is, let me stop sharing this for a second. The first is the new infrastructure, which is the new renewables, the new battery storage that will need to be built out over the course of the next 20 years, and perhaps even some peaking power in terms of gas, which is probably a bad word for this webinar, but South Africa is going to need some flexibility in its grid, but it could be mitigated if battery technology develops fast enough. And that's the quantum that's estimated is over the next 20 years, you're going to need roughly 500 billion rands invested. And actually, it's probably going to be less than that. So, I mean, less in terms of time frame, not in terms of quantum. So large amounts of money needed for new investment. That's principally going to be financed by the private sector. The government doesn't have the money at this point in time. So therefore, you're going to see banks providing the money and initially financed by investors buying bank debt. But as the project pipeline develops, what we would expect to see is an increasing flow of renewable projects which come to the public markets to access financing. So that's not typical transition financing, but it is a big component of it. It's the new infrastructure. The second part of it is the grid enhancements. So Eskom estimates that they're going to have to spend somewhere between 120 and 180 billion rands over the next 10 years to strengthen their grid. We know after the latest round of renewables, the Northern Cape grid, which is the most attractive portion of South Africa in terms of new solar projects, has no more capacity on its grid. So therefore, you have to see a large amount of money being invested in the grid. And that is an area that is ripe for transition finance. So this is investment that will need to be made in order to bring green power to reduce the carbon intensity of the grid. And it makes sense that this is financed with transition finance. The third component is more tricky, and here you probably need more a good slug of grant financing, is helping to deal with the losers from the transition. So the workers at Eskom's power plants, but also the coal mines. And what we see is South African companies like Nexaro being quite proactive about thinking about how they're going to deal with their communities. So that's the third. The last is probably the most contentious, is if we want to incentivize the early closure of coal-fired power stations in a country like South Africa, then we're going to need to think about inter-country or inter-regional financing for that. And that's very much in its early days. So, Sean, your question was, is transition finance something that we think about from an investment perspective in South Africa? Most definitely. Because we see the big electricity utility is going to have to transition. It's going to have to raise transition finance. But then we start to look at it in the corporate sense. So Sasol has recently produced its broad brushstrokes of its transition plan, released on its Capital Markets Day on the 22nd of September. And they have tripled their expectations for carbon reduction or emissions reduction to 2030. It was a 10% reduction previously. They're now looking for 30%. And they have sketched out various pathways to net zero beyond that. They're going to have to finance a lot of the investment needed. The initial plan is to do it off balance sheet. So the increase in solar power will be paid for by the people who build the power, and they will just have offtake agreements. But gas is going to be a big portion of their solution. And there, I could see them needing some aspects of transition finance as well. Once we move beyond the likes of Sasol, there are other companies in the South African market that are going to have to be thinking about this as well. So I think that from an investor perspective, we expect to see companies needing transition finance in the South African market once they've developed cohesive transition plans, because that has to be the first step. A transition plan that I tend to simplify this. I tend to look at 3 dimensions. The first is with a target that's ambitious enough, and that's a subjective way to frame it, but a target that's ambitious enough. The second is something that's been costed for. So does the capital expenditure plan for the entity make sense? Do the numbers make sense? Do the costs and the revenue implications being budgeted for? And the third is, can you monitor this on an ongoing basis? So if companies come with viable transition plans that need to be financed, that is something that we would very much look to support as an investor in the South African market, and an investor in other markets. So this is not only a South Africa specific issue for us, it's an emerging market consideration. And then I think beyond that, if we look at the opportunities for transition in South Africa, I think most people on the call would be quite familiar with them. We have some of the best solar and wind resources in the world, and actually the combination of the two provides a very attractive renewable resource base that we need to take advantage of. What we're starting to see from our mining sector is a number of companies looking to either build their own renewable power or to procure from third-party providers. And the change in the regulations recently to move the cap from 1 megawatt to 100 megawatts of self-generation, or to even allow wholesalers to sell to multiple parties, has resulted in many companies starting to talk to us about their own self-generation plans. We're having a detailed discussion with one company at the moment around this, and what is most startling to me is that very quickly it becomes cheaper for them to self-generate than to buy from Eskom, given the likely trajectory of Eskom's tariff path. So I think we're seeing transition manifest in a number of areas across the markets at this point. I think what we need to see, though, is this more widely accepted framework to assess the transition and to then get comfort that something is a transition bond. We don't want it to become a label that gets slapped on things that doesn't have a worth and a value. Sean, shall I leave it there for now?
Bad start, Nazmira, I have to say. Thank you for that very useful overview and exposition, and also about the nature of your interest. It's a complex issue. The actual pathways, the trajectories of change, how they're going to work when it comes down to transition in a world where we are trying to see a very rapid transition, are challenging. It's hard. I want to bring in Saul Levin, who's done some work on this in a minute. But one of the things that Louise Gardner was pointing out to me, that in the King Code on Corporate Governance in 2016, climate change is included in the preamble as a key risk that needs to be addressed. So boards presumably need to show how they're addressing that risk and responding to it, which might not just be the risk of climate impacts, but also the risks of changes arising out of climate policy, like renewable energy changes. When you're talking about companies finding it cheaper and better to self-generate rather than buy mescom, I'm thinking this is a fallout of policy change or lack of policy change. In a sense, it's part of the big picture of climate change, isn't it? So if you're a board, there's actually a lot of moving parts here to try and get on top of.
So I think what you've seen is, for a long time, ESG factors were separate. You had your financial report, that you produced, and then you had a sustainability report, which had a lot of pretty pictures and was separate. And I think the realization over the last 5 years, from an investor point of view, but also from a corporate point of view, is that ESG factors translate into financial implications over it may not on a 1 month or 2 month period, but they do translate into financial implications on a 5-year period, and the market starts pricing them in much sooner. And therefore, the first step for us for thinking about anything is as simplistic as saying, what are the financial implications of companies with poor climate policies or poor governance or poor social policies? And that feeds very much into the King Code element, is if a company is not taking climate seriously, they are very vulnerable to changes in legislation. To carbon taxes being imposed in South Africa, for example, to being shut out of the EU market. And therefore, we need to think about the revenue implications of that and the rating implication. So you look at Sasol, the biggest impact on the share price hasn't been a profit issue, it's been the derating, because this is viewed as a company that has an emissions problem that there isn't a clear solution as yet. I mean, hopefully, given the plan they announced recently, that will start to change going forward, but that has been the major drag on their share price.
Very interesting point. And you see in a different sense, in the different direction of green bonds, in liquid currencies, green bonds are, well, actually not even liquid currencies, green bonds are generally priced tighter. Not tight enough that it's really hugely material, but it's an indicator of investor preference, we would argue. And in secondary market, green bonds are very popular, and there's a kind of reordering of capital flows going there, where green investments are now lower risk, at least in Europe and the US. Because of that point you raised, they're less likely to be negatively impacted by policy changes. And that's what a taxonomy represents, really. It represents a universe of investments that you've got a reasonable amount of safety, but it's not going to be bummed around by stuff that happens that will have to happen. And that's not just in South African government policy. Note that at the Biden Climate Summit in April, every major economy committed to very strong and robust 2030 targets of emissions reductions, which is clearly going to have a flow-on impact to how we structure the economy of the planet, because of the change of industry, the change of consumer production costs, and the change of demand for South African minerals, resources, and other kinds of resources. So there's a lot of change happening. Trying to pick what safe harbor, particularly if you're a fixed income investor. I don't know, Nazmira, most fixed income investors I know are defensive. It's about not losing your money above all, rather than making it. So this is gold dust, this stuff, isn't it? Identifying what is lower risk.
Exactly. So identifying what is lower risk. I mean, if we look at the work that we're doing on this, what is interesting, Sean, is when we look at our emerging market portfolios, the work we're doing on it is measuring the change. So sustainable emerging market fixed income, it's the change in countries, social factors, environmental factors, and governance factors. Because if you're going to just look at the level, it's not that useful. There's a great correlation between level of sustainability in a country and its income level. So you're just going to end up buying rich countries. What you want to actually measure is the change, the progress that's being made. And that we find very useful. And therefore, all of this stuff you're talking about feeds into that. I think the other point to make, though, is as we do this, we need to be very cognizant about considering the reality of the circumstances in emerging markets. And that's why I keep coming back to this idea of transition plan assessment. And I know that's difficult and it's not easy and it's not as simple as a carbon intensity measure. But one of my real fears at the moment is that with the push to net zero, there's a desire to focus on carbon intensity of portfolios and therefore divest from high emitting companies. And firstly, that has absolutely no benefit for real world carbon reduction. Secondly, there's a real risk that coal producers end up in private hands and actually do expand and don't actually help your carbon reduction at all. So instead of it being a positive thing, it ends up being a negative thing. The second issue is that companies like Sasol, you need to work with them to transition. So I think the more we can shift this debate away from carbon intensity and towards transition plan assessment, the better equipped we are. And that's why I was so excited by the subject matter of the seminar today.
Well, that's a good segue to Saul, but hey, you heard it here, everyone. That sounds like a new paradigm to me rather than just another label. And engagement.
Well, it's up to you to help us provide robustness to it. Because that's the key, is we need a framework that everyone thinks is robust and is not vulnerable to greenwashing.
Indeed. And what Nazmira is referring to is a climate bonds. We've published a document recently, guidelines for entities assessment around these issues around transition. So we're doing more work later in the year. And we hope to see entities certification coming through by the end of the year, where a company with a plan that can be judged to be adequately ambitious and robust to transition can then say, hey, I've got a third-party verification here. Look at me. I'm a transition finance person. I'm part of the broader green and sustainable universe. In a way, as Nazmira, you say, is all about engaging with how we change, not just avoiding it. I mean, if we avoid the tough stuff, we're not going to get anywhere. We'll be shuffling deck chairs in the Titanic as you think from changing the direction of the Titanic. And that's, but that's the fast part. But let me go to Saul, who's the executive director, and we'll come back to Nazmira in a minute, who's the executive director of Trade Industrial Policy Strategies, who's been doing some work on sector transition plans, which is so critical to understanding what in the world is adequately ambitious in this space. How do we actually assess? Please, Saul, tell us what you're doing.
Let me pull up my PowerPoint and then I can talk to that. Okay, so what we a research institute, we're a not-for-profit organization, and what we've been looking at is particularly the just transition. So a focus not only on the transition that needs to happen, and there's been a lot of discussion today on that transition, but really to start looking at what about the communities and the workers that are impacted by all of this. So our research has taken the impact of climate change and the decisions that are required to reduce exposures to emissions, and then looking at the sectors, the value chains, and then what that means then for firms, workers, and communities, and then extrapolate on that to identify some of the gaps in the policy options. So why do we need to worry about these? So it's if we're looking at a socio-economic perspective, we see the impact of highly unequal society in South Africa. We still have massive levels of poverty, although we do have a fairly robust social safety network, and I'll talk a bit about that, but we still remain with those factors. With the impact of a transition away from fossil fuels and the impact of climate change, if we don't have a managed process around it, businesses will close down, workers will be retrenched, and communities will then be pushed further into poverty. That's not sustainable, either from a climate change perspective or a social perspective. So it's you know, I think the issue was raised earlier. It's not just a problem for those workers or those communities. It's all of our problems, and it means that when we're looking at the the finance angle and we're looking at the government action on this, we have to take a broader perspective, because at the end of the day, it is country risk. As we saw earlier this year, there is country risk around some of these things that are not managed well. And it does mean that we need to be applying our mind and putting resources into this space. But what it does mean is that in terms of the timelines, if we start with some of these actions now, we can avoid the social and economic disruption that will take place as we move away from carbon emissions. So our work then took us into looking at who's at risk. So we've got what we would call mono-economy towns. So it's small towns that are dependent on either mining or farming or highly linked to the electricity production system or the petrochemical. So we've got a number of towns that are in that space. We've got small rural towns in our former homelands or labor sending areas that are, they still have strong linkages to the mining and farming sectors in terms of the workers who go there who may still have family back home. And then it's the sectors that are need to or are decarbonizing, and that's, I think we heard some inputs, particularly from Retsumetsi on that earlier, looking at the coal value chain, and that's electricity to petrochemicals, and then it's also the automotive value chain, and that's going into petrol, even petrol pump attendants as we shift to EVs will start to be impacted. And then it's also those sectors that are impacted by climate change. So we've already seen it, and I think it was spoken to earlier as well. The agricultural sector and even our tourism is often dependent on climate change. When you run out of water in Western Cape, it has a very big impact on tourism. So these things are all vulnerable to climate change. What we would normally see is if it was an individual industry, that there'll be a shift that takes place into alternative economic activities. The problem, however, is that given the historical circumstances of South Africa, it's not just a small shift that needs to happen when you're closing down one coal mine, as we've seen often in Western Europe, where there are some towns that were linked to coal mines, but it's broader than that. And so there are a number of mono-economy towns that are at risk, and they have few alternatives. So the response that's required is to accelerate diversification of these economies, and then looking at realistic opportunities and fast-tracking the support systems. The concern is that these small towns do have lower levels of employment, and the population historically, for historical reasons, don't have as good education systems. They have worse infrastructure, and the resources from those towns are lower. So the revenues from the municipalities are then often lower, and the resources they're able to put into economic development activities are lower. So they're already on the back foot with that legacy. And that makes it harder for them on their own to adjust to the decline in their main industries. So what have some of the responses been? What we have is the social and labor plans that mines are required to have. But these are individual, they're not necessarily coordinated, and they're not necessarily sufficient for the massive disruption that we see going to be taking place as we decarbonize. We have national government that needs to play a critical role, the economic departments to support diversification and provide support measures. We have the state-owned enterprises and other institutions that can support change. And then the private sector who can come in and find the new opportunities, the new industries, the new technologies. And we've heard some of that already this morning, and an expansion of capacity by those private sector players. Then there's the international community, and I think that's where a lot of the financing discussion has been centered around today, and the South African finance sector, particularly looking at what do our banks do, but also what happens with individual investors into the economy. So when we've unpacked this a lot more in the research reports, but this is I don't know how you summarize several research reports in one slide, but what we have looked at is there are some things called active labor market policies, reskilling, early retirement, trying to place workers into different opportunities. But these things are limited, particularly given the high unemployment levels that we already have. So there is scope for active labor market policies, but they are limited. There's small business support opportunities, which are required. But we are already on the back foot on the SME environment, which has been made worse by COVID-19. The social protection measures we have in place, they are significant. We have probably one of the best social transfer systems for an upper middle income country. But that means that there's already limited resources to expand. And there are lots of discussions at the moment around expanding it into a basic income grant and extending the COVID-19 grant to make sure that it reaches those that are missed out in the current social protection measures. We've got extensive public employment programs, community work programs, EPWP, which are government-sponsored programs to create community-based opportunities, clearing alien invasive species, or doing community work, things, building schools, fixing schools, things like that, as well as the education support initiative that came about during COVID-19. All of these things have created significant number of employment opportunities. So there is scope to expand these things, but it does need stronger institutional capacity. And then we have a number of industrial policy support measures that we see. There's special economic zones, there's industrial parks, there's a number of government incentives, there's localization, there's other economic infrastructure. And part of the structural change work that's taking place through Operation Vulindlela is around some of that economic infrastructure, fixing the ports, fixing the broadband infrastructure, making sure that some of our other actions, economic infrastructure activities work well. So all of these measures are necessary. They're not necessarily sufficient. They need to be properly resourced. And it does require a strong response from the private sector, because it is all of our problems. So we are also increasingly seeing the global community coming on board to support, and there's been a lot of positive discussions in the build-up to COP26. Moving on then to the financing side. I mean, what we've done is we've gone out and we have the research on our website, and we've tried to think about how do we understand the financing of the projects or business ventures that will be required to support this just transition. So it's not necessarily climate finance. It's around what are the economic activities that can take place in order to create employment, to support the diversification of economies. And we've put together a process to understand it and to categorize the investment. So on the one column, we've got the pricing of the ventures, and then the other side, we've got a scope of how much impact it would make in terms of a just transition. And we have the various indicators on that. And it's a work in progress, but we're slowly building the knowledge around how do we better understand it, and to build that, not quite a taxonomy, but a framework to think about it. We then went out and we found projects, and then we clustered them into these various categories, and we put together some detail on that framework. And some of the key things when we take that analysis forward into the financial ecosystem, it does see us needing to think differently around financing of these things. So we see that there are bigger and less risky investments, but those investments need to be linked to the smaller opportunities so that we have a portfolio of investments. So if we go back to that earlier slide, it's these types of projects in that first quadrant create the opportunities in the second or the third quadrant that will see more jobs being created, that will see economic diversification taking place, and more inclusive industrialization taking place. We then need to look at the blending of financial products, because some of these things, particularly in quadrant 3, might be higher risk. So we need to look at the blending of financial products. And that means we need to think differently about financing of this just transition, and our normal financing systems may require some adjustments in that process. We need to think about, blending finance or de-risking some of the finance, including through the use of grant funding, so that you take away some of the, like first loss facility, for example, take away some of the risk on these things. We may require the finance institutions to look at their timing. So rather than waiting for projects to arrive on their table, they get more involved in project development and structuring the solutions that are required. We also need to think about financing the smaller, the SME type projects, the less than 20 million space, which may require a bit more hand-holding than some institutions usually take. But there are players out there. It will need to be expanded if we're going to get this right to support this just transition. We see space for the venture capital market. It's not particularly well developed in South Africa. There are some players. We have a fairly robust private equity space, but less so in the venture capital. And some of the technologies required will be novel or innovative. And we do need to look at how do we stimulate that market so that we can take forward this just transition. And then all of that will then translate into different approaches to reporting, the metrics, the disclosures, the types of products we have, the risk analysis, and even the remuneration incentives. And there's been some discussion on that today. So my final slide. And what we need to think about is, how do we understand the risk? And if we want to successfully finance a just transition and the projects and the ventures that are emerging, we need to relook at the products and approaches that financial institutions have, and things like, how do we understand the ownership, the terms of the loans, the rates of return? These things need to be put out there, because we do need a change in approach if we're going to see it as all of our responsibility to look at. We need to look at the opportunities on how we use the blended finance to de-risk. And then importantly, and I think it's come through in your last comments, Sean, about signaling change from the top. When we're looking at the King codes, the boards of financial institutions, the executive structures, the credit committees need to look at not only climate change, but the just transition and the social impact, the socioeconomic impacts of all of this. And then actively support the different approaches that are required. These are big shifts that I'm talking about. It does require a new paradigm. And we need to start seeing these elements of a just transition being reflected in ESG reports, King codes, and the JSE requirements. Thanks very much. And that's just an advert on where the information is available. We have multiple sector reports and a just transition portal on our website. Thanks very much.
Thanks all. So you've got a rich load of guidance is the key point. It's challenging. It's hard, isn't it? This stuff. On one hand, we've managed to get a global green bond market and sustainable bond market, and transition is simply an extension of that, which does give price benefit. In the Egyptian market right now, the Egyptian green sovereign is trading at a 75 basis points, 75, you heard from here, basis points benefit to the vanilla bond, which is relevant to their rating level and score. In Europe, it's more like 6 basis points for the negative interest rate German bond. So there's clearly capital preferencing appearing But people need to know when it gets to complex areas like just transition, which is so critical to making sure, well, we can transition, what to invest in, what to do. And what you've given us here, I'm going to say unfortunately, Sol, is a complex menu. There's a lot of issues and a lot of moving parts. I mean, in some ways, this is not that different from how we develop our economies with just a sustainable framework around it. You know, how do we create jobs that stay in places like KwaZulu or whatever? What do we do going forward? And then what are the background governance and government measures? That's really all we're talking about, isn't it? I mean, with just a sustainable filter. Have I got that wrong? But I need to ask you more about the sustainable filter.
Yeah, I mean, you've got it right. I mean, we do have to think differently about the changes and the socio-economic impacts of what's happening in these communities, and look at the sustainability. So it does point to broader government actions that are required, but for certain communities, it's very specific. We also have a situation where...
Can you explain what you mean, Saul? What do you mean for certain communities specific?
So for example, coal mining communities where we see they're dependent, those mono-economy towns where they're dependent on that mineral. If we take, for example, the actions that they could do, coal truck drivers blocking the highways, which we saw a few years ago, if they feel that the transition is not going to be in a way that supports them and is going to negatively impact on them, there's no, you know, it's not negotiable for them. They have to fight. You know, they have to say, otherwise they end up as losers. So we have to put these sustainability measures, and we have to put in the opportunities and the diversification of the economy as front and center. And it is complex. This is not easy stuff. You know, industrializing, diversifying economies. But as we heard from Mandy, they're already looking at it. Eskom have hardwired in the just transition elements into their, you know, shift away from coal-fired power stations into different technologies. That they're already looking at it because they understand that, you know, a simple example, when my research team went out to do this work, I didn't do the work myself, I have to acknowledge them. But when they went out and they spoke to some of the community members, that there was a recognition that, for example, the local filling station, fuel pump station, would go out of business if the power station closed down because there wouldn't be enough traffic. That means that community would have to travel 50 to 100 kilometers just to fill up their tank, which is not sustainable. You know, maybe we can transition them early into electric vehicles, which are, you know, 4 times the price. But you know, there's a whole lot that needs to happen and to be thought about when we're closing down the power stations, when we're moving away from coal. But it's broader than just and I pointed to in my PowerPoint that it's a number of other sectors as well that we need to look at.
I mean, we have to be sympathetic to those mine workers who've got to put food on the table of their family at the end of the day. And we've seen, of course, this same reaction to change on different forms in other countries. In France, we've had the Gilets jaunes, which has been a demonstration against essentially a carbon tax on fuel, is how it started. And that kicked off, of course, as it often does, a whole range of other concerns. As we make these changes, it's important. But there's another thing, I think, which underpins what you're saying, which I'll just share, which is that in a world of climate volatility, which is what we're going to have, and where we have to achieve really rapid changes to mitigation, we need societies to be resilient, and we need to try and avoid step backs as much as we can as we get pushbacks from different groups who are saying, hang on, what about feeding my kids too, kind of thing. Which means our policy planning needs to take account both of those things. Saul, you've been talking about the putting food on my table pushback, which is critical. We've got to diversify economies in these mono-economy towns and create other job opportunities, but also for resilience. You know, inequality, we have a lot of inequality in South Africa, is an indicator of the fragility of societies in the face of big shocks. This is what we know from the last 70 years of global study. So the more unequal a society is, the more likely it is to collapse in one form or another with some kind of large, well, climate-related shocks, as an example. It might fall into anarchy. It might fall into change of government, electing maybe a crazy populist who tweets all the time. These are actually indicators of the sort of volatility that are going to become more likely going forward unless we address the root causes of inequality. And you can certainly look at the US and see some of those inequality challenges that have given rise to the problems that the US is currently dealing with. So we've kind of got a lot of reasons to tackle this, but how, Saul? And I want to bring in Simon and Nazmira in a minute. I'm worried it sounds really complicated. It sounds like you've given me a recipe from a really high-end chef, and I just know how to do pasta or something like that. Give me a little bit more flavor of what it means for an investor, how it would actually work out, and what's possible now.
So I mean, what we're saying is that in the short term, there's going to be, if we look at my quadrants that I put up there, in that first cluster, there are projects that the current finance system can finance. So, for example, repurposing of a power station, shift to new technologies. Eskom has got a whole range of options that can take place there. There might be others where you have large scale investments using existing technologies that can then provide opportunity. So, for example, one of the projects that we looked at was cleaning mine water, or using the mining agricultural land, the agricultural land that's next to the mine differently. Fixing up some of when you rehabilitate the mines, you can put in certain agricultural products. It may not need to be food. You could look at other agricultural products for industrial purposes. So there's a whole lot of things that can happen now, big scale projects, but we need to then look at the linkages to the smaller opportunities that can emerge out of that, and not shy away from it by saying, okay, we're just going to focus on the easy stuff. So we are asking the finance sector, we're saying you need to push yourselves, because this is a sustainability for your company as well. And Nazmira spoke about that. It's important that we all look at these issues and not just close ourselves off and say, well, it's not my problem. It is our problem. So we are pushing the boundaries on that and saying, when you do those big ventures, let's also look at the other economic opportunities, the downstream opportunities that can then emerge. And we're also then saying, and it's not just for one player in the space. We're saying there's an ecosystem that needs to work with each other. So the first loss facilities, the credit guarantees that need to come in to make sure that some of these ventures are de-risked, and there's a lot of ideas that we're generating around that. And this, I must tell you, is still a work in progress. We've been at it for about just over a year now, and we're still building our knowledge base around it. But we're happy to share it. We've been in a number of platforms, and as we're building the knowledge and learning from some international experience, although not all of it has already, some of it is new. A lot of this just transition stuff we are seeing as fairly novel. But when we look at India, for example, we see green bonds that have been, through something like a Grameen Bank, have been accessible for smaller type ventures that are needed with a different business model. We don't have a great approach to that in South Africa. We have some state institutions that operate at that level. The banks have tried that. They've been a little bit burnt in it. And so we need a rethink about how we're going to make it work in South Africa. But it does require a bit more effort. I'm not saying this is easy stuff. I agree. Sorry. And I know it's complex.
Look, it is challenging, but it's so important, isn't it? Because we're not going to be able to make the necessary transition without a lot more problems unless we deal with the just aspect of the transition. So thank you, Saul. Folks, if you want to ask a question, you have a short window now to get a question in for Nazmira, Saul, or Simon. Please do put it in the comments box on the side. Nazmira, this is tough. How does this place? What do you see the opportunity from appearing now? Are there any opportunities which also adequately or properly pick up just transition? Can you see this becoming a kind of subset of this broader sustainable asset class? What's your reaction to what Saul's talking about?
I completely agree with Saul that it's vital that we deal with these social issues, because I think that if we don't, the transition will take much longer in South Africa, because you will see this rejection. And so I think it's really important that it's dealt with. I don't have easy answers, Sean. If the issue is there's a nice, we have a nice little formula on how to assess robust transition plans, I don't have an easy answer on how to integrate social dynamics, retrain workers, retire workers early, and keep communities robust. But I think what is quite heartening is that a lot of the larger South African companies that are involved in this space are taking this quite seriously. So whether that's the coal miners, one of my frustrations with Anglo-American unbundling Tungela to apparently improve his rating, Mark Fani improve his rating, is it disempowered the entity to deal with these issues. They're much better equipped as Anglo-American with a large corporate office and a history of doing some really good CSI to actually take this on than a much smaller entity with none of those resources is. So I am vehemently against divestment of your dirty emitting divisions. I get frustrated with my own team members when they say that, because I think you do need resource to deal with these issues. We see Eskom starting to deal with it, trying to come up with plans. We see other corporates in South Africa doing it. I think we're going to need more money. So, when we talk about this just transition in emerging markets, part of it is going to involve some sort of transfers from the developed world to the emerging world to accelerate this in order to deal with these social dislocations.
Interesting point. I suspect we're not going to get transfers in cash. Look, they haven't even got the 100 billion, which is now a trivial amount of money compared to what we need to do. But we can get is credit support. In other words, we've still got to manufacture investments, but we can get credit support to get low interest rates. I think that's doable. That still requires about a package investments, though, no?
It's not enough. I hate to tell you this. So Germany can, engineer its own transition as fast as it wants, but it's still going to face floods and massive issues unless they deal with emissions in emerging markets.
I know the trouble is the reality of it is
when the European Union provides 10 billion euros for Poland's transition, that's great. That makes sense. It's on their doorstep, but they're still affected by Indonesia's emissions and South Africa's emissions and others. And we're going to have to find a way around it. And it's uncomfortable and it's difficult. And maybe we need to use SDRs as a mechanism to finance it. But we're going to have to find a way to do this, because cheap loans is not enough.
Challenging one, because of course you end up having to have a few really bad climate effects, like the flooding in Germany, if we will sort of start waking up to it. And actually something else happens to happen. It's a bit like the Gilets jaunes or the mine workers. You actually get populist politicians become leaders, and the whole idea goes out the window. So it's a really challenging process. And for our listeners out there, it is worth noting that the history of climate change in the human species, of which there's been a lot of incidences, the 1600s, the medieval times, the end of the Roman Empire, all of which are associated with drastic economic and social changes, including plagues, are also associated with the collapse of world orders and wars. In other words, we haven't actually got a good track record of managing volatility and transition going through. In the 1600s, we actually lost a third of the world's population, a third, as a result of plagues and war and famine because of 2 degrees cooling. So that's kind of what we're looking at here, which means get in early and don't before it becomes too much of a problem. And that, of course, is a direct message to the European Union and to the US government. Get in early, because we can't afford to let this become too much of a problem. But it's still challenging to figure out what to do and what's going to be useful versus, I'm going to say it's all, this is a challenge, versus a lobby group saying, hang on, look at me. And in Europe right now, in the UK, there are all these gas-dependent energy companies saying, oh, I'm having a really tough time. The gas price is high. Subsidize me. Whereas actually the money should probably be going to transition, not to et cetera, et cetera. Simone, in the social guidance we've done, and I'm thinking particularly the EU taxonomy, we started to try and address these issues to pick up the social agenda. Can you just share with our listeners where we've got to on this journey that we're on?
Yeah, thank you, Sean. So I can't give too many details because, as you know, the report is just being finished and should actually come out, should be with the Commission by end of this year to look at it. But we are indeed, and I'm glad there has been so much talk about social transition already, and I briefly mentioned that as well, that the Climate Transition Finance Handbook also addresses this kind of the other side of the coin of the climate transition, right? So in the social taxonomy, which will be sort of the counterpart or the equivalent almost to the green taxonomy, we have tried to replicate the environmental taxonomy that you have intensively worked on. But I have to say, and you will know this, Sean, but just for the audience, it is a lot more difficult, I would argue, because at least on the environmental side, which is not easy, so I'm not saying it's easy, but at least on the environmental side, we have things like science-based metrics, right? We have the ultimate goal we want to get to. We have the Paris Agreement. We have so many parameters, and we have the sectors we can look at that have the highest emissions, sectors that contribute the most to reducing emissions. On the social side, I mean, what is the ultimate game? It's not, there's not a certain level of child labor, that's acceptable, or a certain level of forced labor, or a certain level of human rights abuses. So it's really difficult in a way, but we have tried, and you will see that in the report. We have looked at certain objectives. We have, of course, incorporated what's already in the minimum safeguards in the environmental taxonomy. And for those of you who are not that familiar with that, that looks at on entity level at things like OECD guidelines, International Labour Organization standards, UN guiding principles, UN Global Compact, and so on. So we've taken elements from those, and rather than science-based, we looked at processes and tried to go there. But it's still difficult to come up with what does it mean to substantially contribute to goals in that space.
I want to say one of the things we're trying to do, and I won't say the EU platform because that's a formal government body, but the climate policy issue with this social and resilience, because we're now looking at mapping climate resilience measures against the UN SDGs, noting that resilience is more than physical resilience, it's social and economic resilience, which picks up Saul's agenda absolutely squarely, to try and flesh out what that might mean in investment universe. But when we do a taxonomy, it's not so much deciding what's just going to work for green bonds or finances. It's also about a prioritization of government measures and government support. So it works both ways. And in Europe, the European Commission will be requiring in the future member states to report against the taxonomy and their expenditures and what they're doing as well, which gives you a bit of clues to where we're going. Now, what we can do is bring in first guarantees and other kinds of measures, the less than perfect measures, as Mira, to shift money. What does need to then be related to, if you're going to subsidize, if you're going to invest, here's a universe. Don't go beyond the universe because the work's been already done to work out what is relevant. This is why we need a fleshing out of the right kinds, the most efficacious social or transition measures as much as we can, because everyone needs guidance. And to be honest, most governments, they're stumbling in the dark here, figuring out exactly what to do. They don't really know. And there's lots and lots of lobby groups, and the major lobby groups are the loudest ones, which are the legacy ones, not the new ones. The people trying to keep something in place rather than replace it with what we need to change. And that's the difficulty with transition. Transition does not mean keeping Eskom's coal plants going past 2050. Let's be clear about that. Mm-hmm. Transition means they go, but we find a future for all the mine workers, which is sustainable and keeps them putting food on the table. That's what it's going to look like. I'm not trying to say that's easy, by the way. Saul's told us how difficult that is. But that's the ambition, right?
Sean, you're right. You're right. I mean, it doesn't mean keeping their plants going past 2050. I mean, I would hope it doesn't mean keeping most of their plants going much beyond 2045, maybe even a bit earlier. But it's a question of how you finance and the mechanisms you find. And I think you need all these types of financing.
Yes.
So I agree. The credit enhancements have a really important role to play, because what we've seen is the average developed market investor has a very high, their perception of risk in emerging markets is higher than the default data suggests is real. What we've seen over the last 30, 40 years in terms of default rates for infrastructure in emerging markets is much lower than the general perception of risk is.
Absolutely.
And therefore the return that is demanded is inordinately high for that infrastructure. So therefore, anything we can do to close that gap makes financing a transition easier and more affordable. And using credit enhancements is one of those ways. I think using credit enhancements in initial funds, which then allows further funds to come in after that, once the point's been proved, is very valuable. I mean, another point that I would urge them to do is for the multilaterals to make their data sets available. They are very averse to doing so, but the more data that's available that proves this point, the better it is.
Interesting point. So I'll put that to my colleagues as a forward issue. We'll see how we go on that. We had a specific question come up from Gray Maguire, which I'm just interested if anyone's got a view, which is, what about offsets as a mechanism for finance transfers? There are more than carbon offsets. There's opportunity for various kinds of landscape, community conservation offsets, and so on. I'll hold my views for a minute.
I'll give you my views. We'll probably disagree again. I think if you can make them robust. So the issue with offsets is there's too much garbage.
Well said. Well said.
So, people use offsets and it's not a real thing. It doesn't actually have the intended benefit in terms of either carbon reduction or biodiversity preservation or whatever it's meant to be. So I think if we can get some sort of robust framework around that, I think carbon offsets have a really critical role to play. So you go back to the discussion you and I were having. If Eskom could turn around and say, we're willing to provide a gigaton of carbon reduction beyond IRP 2019, use the integrated resource plan of 2019 as the base case, and say we can provide a gigaton of carbon reduction extra if the market will buy this carbon reduction. That would be enormously beneficial for Eskom and could bring forward your closure date for a number of plants by up to 10 years.
So you've raised an interesting point there, and for Gray, offsets mustn't be used to keep doing what you're doing. And some offsets have been using that, right? You have to work on the envelope of your asset. But changing the envelope of your asset is challenging and can take some time. Take aviation. We can shift to bioavgas quickly. We can. It's available, the resource is available. We don't need to keep using kerosene. But we've still got emissions there. It's going to take us another 20 or 30 years before we shift the fleet to hydrogen-based planes, which is what's likely to happen. In that meantime, we should be using offsets for the carbon that we can't stop in the transition plan and funding a whole lot of activities, would be my angle. So I'm not going to say to Eskom, keep pumping out pollution through coal plants and just buy offsets. You maximize the transition pathway you can achieve, but you use offsets as part of the transition pathway. So it's a hybrid of the way I put. So I think we might be on the same page here, Nazmira.
I was about to say, it sounds like we agree, Sean.
Simone, do you want to dive into this hairy issue?
It's not a core area for ICMA, of course, but I fully agree with you both as well. And I would say, indeed, for a lot of sectors, you still need to. We're kind of still waiting for the technology to be developed, right, to decarbonize. And offsets, while I think should only be a second line, and in the first place, they should actually try to reduce their emissions. But but they can use that in the meantime. But it needs to be, a bit. Currently, it's a bit chaotic, and there are certain initiatives out there, several initiatives. The most prominent probably being the task force on scaling voluntary carbon markets under Mark Carney, which I'm sure we'll hear a lot more about during the COP26. They have come out with some carbon principles, but we will have to see what they're really trying to achieve and what they can achieve with this.
Sorry, Ismira, go ahead.
No, I was going to say, and I think for emerging markets, where there's a verifiable saving or preservation, to be able to sell offsets in order to obtain the financial transfers to either preserve the environment or to actually reduce the carbon. So you get paid for action taken rather than the promise of it. I think if we can introduce some sort of standardization and integrity into that market, it could become quite catalytic.
Absolutely right. That's a really important thought going forward. We need to start wrapping up the session. So think about your closing remarks, and I'm going to give you a very specific instruction. Please give people hope. We have a deep challenge, and the news isn't all good. The climate news we're getting is grim. We have to do a hell of a lot on all of these fronts, not just mitigation, not just adaptation, but also making sure it works for the people in our societies and our economies so they don't freak out. Understandably, they might freak out if they think it's going to go against them. So there's a lot to be done. But at the same time, we've got some things going for us, haven't we? Nazmira, Saul, Simon, each of your work. So final comments. Maybe I might go to Saul first, who's been suspiciously silent for a while. and also, Saul, by the way, if you think there's an offsets angle to the transition, let us know. But to you first.
Okay, so I mean, on the positive side, what we are seeing, there's a lot of opportunities. There are possibilities of supporting a just transition. We're seeing there's a lot of tools that government has that it can draw on. It does need the resources. And we're seeing private enterprise looking for opportunities in these communities and in these spaces. So, where the finance comes from, I would agree. If we can get some aspect of offsets to ensure that funding goes towards a just transition, it would really make the case for it. And we're seeing a lot of appetite from private sector finance institutions who are starting to engage. I think there's definitely a recognition that we're moving in the right direction, and we have to start onboarding a change in approach. So I'm seeing positive movement. The discussions we've had with international DFIs and MDBs has been very positive. They are looking at this space. They are looking at the credit mechanisms or the de-risking mechanisms that can be brought in, and are supporting some of the thinking around how do we develop the right ecosystem that's going to enable this transition to be just. Thanks.
So Saul, can you see it happening? I mean, do you have a light at the end of your tunnel? Or is it really still dark at the moment and you're trying to get a light going?
I'm an optimist, so I am seeing light, and I'm seeing a lot of positive engagement. Look, it's when you're in a dark room, there's furniture in the way, and if you get to the door, you open the door, and you could look back and say, "Oh, that was easy." So I do feel like I'm in the dark room at the moment, feeling the furniture as we're trying to find that doorway. But I know that the doorway is there, and it's going to be complicated. But once we get back and we open the door and we say, oh, okay, now we understand what needs to be done. So I think as we engaging, as we fumbling through this, and as everyone is excited about the possibilities of what we can finance, I'm seeing, I am hopeful, and a lot of positive engagements. People are worried about climate change, and they are worried about how we support the transition and make sure that it's just. It's a conversation that the president of South Africa is engaged in. It's a conversation that international people that we talk to are engaging in.
Thank you. Simon.
Well, difficult in just a few minutes, but I would say, in the spirit of the heading for our panel, maybe is transition finance just another label, or is it a new paradigm for the financial sector in that case? But I would say not just for the financial sector. Transition finance is here to stay. It needs to stay because we have to really get everyone on board. Also, the hard to abate sectors. We need to help them finance their transition, not finance anything that's going to become a stranded asset, so not lock in anything, as I think emphasized a few times, but really finance the transition. And for that, they have to also make a credible plan. They should be transparent on that. And I think in the future, we'll probably see more like, Total earlier this year, as the CEO announced that going forward, all their new bond issues will in fact be linked to climate-linked indicators. So I think going forward, we will see a lot more like this, that companies are really coming around to really restructure their whole corporate finance around anything that has to do, really brings the whole company together on this transition journey and get the market to help them finance it.
Thank you. Nazmira, in your role as representing the $110 trillion global institutional investment sector, your final reflections.
Thanks, Sean. I'm hopeful on several measures. So on a South Africa perspective, the Cabinet recently passed a emissions commitment that is broadly aligned with 1.5 degrees. So that if we're talking about leadership from the top, that's the first step. The issue now is making it implementable primarily through Eskom and Sasol, and both of those entities are grappling with this in a significant and serious way. So I'm hopeful there's progress there. It's not as fast as we want, but I'm hopeful there. The other issue that I've gotten more hopeful on is I got really worried about 6 months ago that net zero was going to be implied in a manner that sucked capital out of emerging markets and ended up in US tech. And what we're hearing over the last 2 months is this discussion is rapidly shifting. It's not shifted far enough, but this discussion is rapidly shifting away from simply measuring carbon intensity to Simone's point, which is working with your heavy emitters. And as long as we continue to see progress on that score, I think we can find a real world solution to this problem.
Well, that's a cheery message. Thank you. Of course, implied in everyone's comments, and you've heard it throughout the whole session, there's work to be done. Unfortunately, time is very short. The window we have to get emissions down, just in that first measure, is, well, we've got to reduce global emissions by 55% by 2030, according to the IPC, to have even a reasonable chance of avoiding catastrophic impacts for our people. And of course, South Africa is one of the places that's most right in the firing line of the kind of catastrophic impacts that we're talking about here. So it's kind of, it's such a short amount of time. It's amazing. It's doable. It's doable for two reasons. One is we have the capital. We have more capital on the planet now than ever before in the history of the human species. And large slabs of that capital is sitting around in negative interest rate bonds, like German bonds or Japanese government bonds, looking for a bit of yield. They're a bit frightened of high risk, which is why we need the development banks and governments like the Germans to step in and pick up the high risk to make that capital flow, whether it be through 91 or directly, whatever, the capital must flow. And it is going to be a big chunk of north-south capital. It's a short amount of time. Given it's such a short amount of time, we can't afford falling into a chasm and then having to climb out again to get back on the road, which means we have to be super careful of just transition issues. We've got to get it right. We've got to carry our people with us. I mean, of course, we need to do it anyway, but the time frame makes it even more urgent to get that part of it right. We've got to have an economy, build an economy that's productive, that's constructive, that provides jobs for our young and for the people whose lives are going to change. It's going to happen. We've just got to try and make it happen in a way which isn't destructive. and in a sense constructive. All of these are critical parts of the job. The good news is we're talking about it. The good news is we have the capital. The good news is we've proven the capital will invest in green and some traditional investments as we flesh it out. That's why we've got a $2.5 trillion green and sustainable bond market so far around the world and growing at an incredible rate. We've just got to now expand it into areas that make a difference for us. So that's our work around the table. That's your work in the community. That's the work of rich countries as well as less rich countries. Because after all, that's where the policy work's got to be done, right? If the less rich countries, like South Africa, don't have the policy settings in place, the money will not flow. We will have fights instead of collaboration. So we've got work to do on all sides. And time is so short, but we leave this panel optimistic. There is a chance. Just remember, it's a chance. It's not a certainty. It requires all of us to get our act together damn fast. Thank you so much, Nazmeera. Thank you so much, Saul. Thank you so much, Simone, for joining us today. And thank you, I suppose, Tips, for all the work you're doing, but fundamentally, thank you for the Johannesburg Stock Exchange for hosting this event.
And thank you, Sean, for facilitating a very rich panel. So my first encounter with green bonds was your presentation to regulators and banking associations in 2015 in Indonesia. And your enthusiasm was inspiring, but I think the results and the what then subsequently happened in terms of those countries, those emerging markets, which are now 43 emerging markets, wanting to move very rapidly to put in place the conditions for green bonds and green finance. And then we saw what happened with China when they introduced their taxonomy in 2015. Then they were 30% of green bond issuance globally in 2016. So I actually have a high level of certainty that we will actually be moving quite quickly on transition, because it's happening already and much faster than what it seemed to happen with green bonds. So thank you so much, Sean, for facilitating. And I now have the opportunity to wrap up and close out proceedings for today. I do want to touch on some of the key messages that came through very consistently through both panels. My favorite quote was from Nazmeera, I think, which is, "If we avoid the tough stuff, we are not going to get anywhere." And that came through in a number of the contributions, that there's work to be done. It's unclear. We're walking through a dark room. We're stumbling over furniture, but we're not alone. There are many organizations currently focusing on this topic. And as Simone mentioned, ICMA has applied themselves. Their handbook came out this year. It provides very practical guidance. And they're already investors and corporates quickly moving to see how they can design credible transition. Sean, I was very glad to hear about the guidelines for entities assessment and the work that you're going to be doing on verifiers. We look forward to updates on that very soon. And then Nigel Beck made a very powerful case for the need for collective response within South Africa. There's a lot of work that needs to be done. I think this was said again and again. There's a hell of a lot that needs to be done, and it needs to be done through collaboration. I think Saul also made this point, particularly on the just transition side, managing the social impacts. But we can do it. We can collectively work on the enabling environment, on the financing instruments, and also in terms of the solutions, the particular solutions focused on communities. Nigel also talked about how we're seeing the overlay of sustainability strategy on financial strategy. We talked about the role of boards in making that happen, aligning climate change and social and economic realities. That's what Vukile said, and that the transition is here. And I think what's really optimistic is South Africa is moving quickly. There's a green finance taxonomy which starts to pull together both the opportunity side and the risk side. I think an important thing for everyone on listening in to take on board is the taxonomy will be an evolving instrument, and it requires feedback from the market. So don't be shy in terms of providing your feedback. We're already hearing very, very practical feedback from asset managers, pension funds, development finance institutions on how it will work in practice. South Africa is aligning with the EU as much as possible, but there are local realities that need to be taken into consideration, and this needs to work for the market. But South Africa can be a leader. Sean said this, I think, almost 2 years ago, particularly on the transition finance and the just transition topic. South Africa has an important contribution to make to the global stage. So I really appreciate the work that was shared today. And I think tips as well. Thank you for your recent publications and contribution to this work, and to the NBI that are doing such important research around the transition pathways. So it's difficult to mention everybody. I do also want to thank the organizers in the background, and Shamila will come back in to do a few closing remarks in a second, but just a shout out to Veronica, Ashley, and colleagues in the background that have been making all this possible, to the JSC team who have worked with us very closely to make this possible, and then also an acknowledgement to the GIZ, the German Agency for International Cooperation. They played an important role in the conceptualization of this event and realizing that it needed to happen sooner rather than later. And then thank you to IFC colleagues, Dio and Malanga, for your support in bringing all of this together. And with that, a big thank you and a handover to Shamila to end the event today.
Thank you very much, Louise. Not much left for me to say, but of course you can't thank yourself. So I want to say a huge thank you to the IFC team, Louise here, of course, Malango that you saw earlier, and the teams behind them that have made this possible. To all our speakers who joined with us today, we don't take for granted a minute the amount of time that you've spent and what this means in a busy schedule that is just getting busier and busier. We're hugely grateful. I think our audience is as grateful, because what you've shared with us today are insights that are not easy to come by. Very grateful for that. Very grateful for the team at Flock who have made this possible for us. We've got Veronica, Ashley, and the team there, the team at the JSE. We have Zenith and we have Tato, who work tirelessly behind the scenes to make this happen. These things are never easy things to pull together. And grateful for your time once more. And I think, for me from the JSE to say, we can't thrive in a society that is failing. None of us can. Creating resilient markets, working together to create a sustainable future is really in all of our hands. And we look forward to working with you to grow shared prosperity. Thank you, everybody. This brings to an end this year's Sustainability Showcase, being the third of 3 sessions that we've had over the last 2 days. It's been fantastic to spend the time with you, and have a wonderful afternoon, and we will see you again next year. Thank you.